Welcome to our first episode of STOKR Insights. This is still a working title of our future audio and video cast series. So this episode is like the first one of all of them, and normally I'm together with Anna Bnaska. Anna Bnaska unfortunately cannot make it for this episode, but as like these developments over the last weekend have shouted out for for a new view on all these topics, and that's why we started now today with this specific episode. And we will talk about the fail of the Silicon Valley Bank in California, and what this actually means for financial markets going forward. In particular, view also about what does it mean actually for the value proposition also of distributed ledger technology. But first, we will look into a little bit of broader picture, what actually was like the outset of this failure in Silicon Valley. From a monetary perspective, we look at the Fed policy a little bit back, also back to the first financial crisis, this millennia in 2008. This is very important to bring all these kind of stones into context. Then we will definitely look also into the micro economics. So we will look into what kind of decisions the management of Silicon Valley Bank did that ultimately then led actually to the bank run. Then we will look into what actually is like the status quo right now, what happened actually, what defaulted over the weekend, and what is the solution right now. And then we will look into the future and evaluate a little bit what this all maybe mean for all of us, and also for the financial industry in total, and also in particular with a view what is actually really happening in the US. So let's start, and let's go back a little bit in time and think about what happened in 2008 with this mortgage security crisis, and what then ultimately led also like to the loose monetary policy of the Federal Reserve Bank in US. So when we look back into the last 10 or for almost 15 years, we will note that actually we always rescued somehow the banking system, and how it was always done is like with a very loose monetary policy. And I think this we just have to acknowledge in this context. And people were warning for a long time about inflation, and it's probably a myth that this is only a result actually of the COVID times, because inflation also exists in assets, and with loose monetary policy we have seen also in the years before 2020, 2018, 2019, and the years before even rising asset prices in the stock markets, but also like of course like in real estate. So a lot of money was pumping up actually the assets market. And then the second step logically is always that the inflation, the measurable inflation with goods and the like, will also rise as a result actually of such a policy. So this is like the outset. So as you know, before like the first increases in 2020. The interest rates were on historical low levels, which means money was very much available, and this we have seen in startup valuations, but also at market valuations of Nasdaq listed companies. But we have also observed this next door with increasing prices of real estate, and obviously also the crypto sphere has somehow also benefited also from this loose monetary policy, I would say, at least when you look only into price increases. Obviously, there are other components to this technology than the pure speculative element. So, so this is like the outset actually where we were in, and then in 2022 the Fed started to realize that actually inflation is there, and it's not a transitory phenomenon, as they like to speak, that everything is somehow transitory. The transitory inflation myth has played out as a myth, but not as the truth. let's say it like this. And so what happened then? They had like to increase like the rates dramatically over a year, and now we are at around 4.5, between 4.5 and 4.75% interest or rate of the Federal Reserve Bank. So it's a tremendous increase in rates. And when you think an ultimate or the immediate effect actually of these rates they have on debt instruments, specifically debt instruments issued by the Treasury, so-called T-bills or Treasury instruments, which have a certain maturity and a fixed interest rate. So let's think a little bit what banks could do at that time when they were like so low interest rates. They had to make some business. So also what the Silicon Valley Bank did, they lent out money to on very interesting conditions to startups and founders. They also deposited the money of these guys, and specifically of a lot of tech companies, but also companies being in the wine business. A lot of founder money was lying at the Silicon Valley Bank. So they had a very interesting client base, but also like not very well diversified. So in this context, in 2021, like the valuations of all these startups and tech companies were on their highest point. The interest rates were on the lowest. So the bank had a lot of deposits and sort of what to do with these deposits. And then they made a decision at that time, which is very risky. They said, okay, I will buy these kind of treasury bills with a very long maturity, so a long-lasting life, to extremely low interest rates. Everybody can think what happens now when the interest rates are rising. The same instruments are much more attractive, and these will fall automatically in value. And that is exactly what happened like last week on Wednesday, when the Silicon Valley Bank announced that they had to sell one of their investment instruments at a loss, and the loss was around, I think, 1.5 billion US dollars. And then in the context of diminishing now deposits at the bank, because in 2021 everybody had like it's full of money. The tech companies had incredible valuations, and the same thing for the startups. But with the rising interest rate, the second effect was actually that this money dried up. The need for actually risk investment was diminishing because you could simply say, okay, I will invest into a treasury bill and I get 4.5%. Why should I take these high risks? So the money was getting less and less at Silicon Valley Bank, and at the same time, the value of their assets were also decreasing, and this gap somebody noticed. And one of the somebodies was interestingly Peter Thiel, and he said there is something wrong with this bank when they announced this loss, and that there might be like a sort of liquidity issue. And he said, okay, let's take the money from the bank, right? Immediately he called up all the founders of companies they invested in, and he was not the only one. There were also other VCs who urged actually to get the money out of this bank. And this combination of these effects led finally on Friday to the takeover or the take into administration of the FDIC, which is a depository institute, but at the same time also has a role as a regulator. So it's a little bit of a mixed governmental institution. And then the weekend, we all know the weekend came and everybody was speculating what it would mean actually for this Silicon Valley, and especially for the tech industry, because a lot of tech companies had actually their only account apparently at this bank. And Circle, for example, the stable coin, they had like around $3 billion US, and there were other companies like Roblox, listed companies and the like, who had accounts at the Silicon Valley Bank. And so this bank run then ultimately led actually to this to the takeover of this regulator. And then the discussion was what will happen then on Monday. Can we still pay like payrolls? Can we still like survive actually? Because what was insured were only 250,000 US dollars, and that might be like enough for a single person, depending on the age, obviously, and then but it's not enough for a company to pay payrolls. So this is like something where a lot of companies thought, okay, we will go bankrupt. But we know now today is Wednesday, the 15th of March 2023. So this all happened over the last weekend. And now we know that Janet Yellen was announcing that they will do a backstop. So she spoke for the Treasury, for the US Treasury. Then everybody was thinking, what is does this mean actually a backstop? But finally, we all found out that it means actually that the people who have deposited money at this bank should be untouched by this kind of events. So she said, okay, we will not take tax money for this. We have like a fund where we manage the fees of our banks, which we work with, and nobody will be harmed. It's very interesting, like this perspective. Okay, when you take it word by word, it's totally correct. But when you think about it, it's not correct, because what happens actually when another bank is in such a situation, and does this fund also cover this kind of failure? Then at least logically this purse will get smaller and smaller and smaller. And who is behind this fund in the end? It's actually taxpayer ownership, and the Treasury is mainly managing also taxpayers' money. So finally, obviously, the taxpayers will have the burden of such an action, specifically when it is done by the Treasury. Would be like a different view when the Fed would have intervened and and taking over such liability by printing money. But this, so far at least on today's knowledge, did not happen. So like the burden is all on the American taxpayers. And yeah, now you can think, okay, what's the matter, right? What does it mean actually for me, and why is this event? Why do we think actually this event is so important? And then you can look at now like a little bit bottom up and look like, okay, what happens now with Silicon Valley? Silicon Valley founders are untouched by most likely untouched by these events, depending on whether the Silicon Valley Bank can still operate afterwards. But the mindset of the people will change, right? And they will think, yeah, maybe I want to have like a little bit more bank accounts, like I will diversify, which is definitely a good advice. Everybody should have several bank accounts. But they can also think, yeah, but maybe I don't want to bother with these like smaller banks. It's like much too risky. I will open like a bank account in one of these 3-4 big banks, like Bank of America. And then I'm more or less safe because they are always systemic. So this is like a potential outcome. What we could see, and this will obviously lead to a concentration on the banking level with higher fees probably and less service quality. So these kind of developments, everybody should take into considerations as maybe a potential fallout of what happened, independent of whether now other banks will also fail immediately or not. But ultimately, when this movement would go to the big banks, the smaller banks would have less say and would have less assets, and they get a little bit unimportant probably over the time. So this is like a potential outcome from this perspective, but you can also look at it a little bit from a more global level. And then I read that they are also like the Indian startup community, also like the Chinese startup community was impacted or potentially impacted by a failure of the Silicon Valley Bank. And there you see like also like an international dimension where maybe some people will say, hey, this US does not look so stable actually anymore as we thought. Do we really want to trust the American financial system? Because in the end, it's struggling since the financial crisis. And this you have to see also in a longer perspective, because it's trying to do things and rescue, and says always like, yeah, the system is perfectly working, but we could see over the weekend it's not really perfectly working, and it's not thought through with all the debt which is issued by a central bank, right? So this might lead like to some foreign lenders who US is totally dependent on buying like all these treasury bills. Maybe they might say, no, maybe I will not put my money somewhere else, and then this might lead in the end like to the fall of the reserve currency US dollar. You can think like maybe it's far-fetched right now from this little event in the Silicon Valley in California. However, like you see like first cracks here and there, and I think something is definitely to be taken into consideration. I would not go so far as Kim.com. I've listened to him on Twitter over the weekend, and he was saying that he has started that foreign interest in US debt has decreased by 10%. I cannot verify like this number, but I think like this is a discussion which is interesting, and also like an development everybody should continue to observe carefully. right? So from our perspective, the banking system does not look like very much in order, independent of what will now happen over the next weeks and months. And yeah, and finally we can also say, yeah, but maybe it's not such a bad idea to be able to hold your assets actually in a wallet, whether these are cash or whether these are securities. It might be a pretty good idea in the end, and I think it also, like such an event demystifies also like these kind of continuous repetition of influential people in the financial world who recently said, for example, one of the managers of I think of the Basel Bank of International Settlements said that there is no observed use case of blockchain technology because the system is just perfectly working and also working perfectly fine. And yeah, and here we can definitely say as of today that these kind of statements are not true anymore. So I will end with these thoughts. This is like our first episode. I definitely will also go a little bit more into the financial framework, for example, and to the Basel framework and what it also means for tokenization. We will dive into also then maybe like together with Arnab and other participants into different topics and bring in full insightful insights, I hope, into this extremely exciting moments of also financial markets. So take care and yeah, and see you soon. Bye.